Hello everyone. Today, let we talking about impact of derivatives of international financial system. Our group have two members, Lia Zhen and Gong Yining. And our presentation have six parts. Firstly, let's talking about definition of derivatives. The term derivatives refer to a type of financial contract whose value is dependent on an underlying asset, a group of assets, or a benchmark. Derivatives are agreements set between two or more parties that can be traded on an exchange or over the counter, OTC. These contracts can be used to trade any number of assets and come with their own risks. Prices for derivatives derive from fluctuations in the prices of underlying assets. These financial securities are commonly used to access certain markets and may be traded to hedge against the risk. Derivatives can be used to either mitigate risk or assume risk with the expectation of commensurate reward. Derivatives can move risk levels from the risk-averse to the risk seekers. Then, types of derivatives. Derivatives contracts are generally categorized into four main types. The first one is forwards, customized agreements between two parties to buy or sell an asset at a specified price on a future date. Forwards are traded over the counter rather than on exchanges, which adds flexibility but also counterparty risk. Secondly, futures, standardized contracts traded on exchanges that obligate the purchase or sale of an asset at a future date and price. Futures reduce counterparty risk compared to forwards because the exchange acts as an intermediary providing standardization and transparency. The third one is options, contracts that give the buyer the right, but not the obligation, to buy or sell an asset at a specified price before or on a specific date. Options come in two types, call options, right to buy, and put options, right to sell, making them versatile for various investment and hedging strategies. Fourth one, swaps, agreements between two parties to exchange cash flows or other financial instruments, often used to manage interest rate or currency exchange rate risks. Common types include interest rate swaps and currency swaps. Then, positive impact of derivatives. The first one is cross-border risk hedging. Participants in international financial markets, especially multinational corporations and financial institutions, face risks related to exchange rate, interest rate, and commodity price fluctuations. Derivatives like foreign exchange and interest rate derivatives helps firms and institutions mitigate exchange rate risks, stabilizing international transactions. This contributes to greater stability in global markets. Secondly, enhancing capital flow resilience. Derivatives improve liquidity in international financial markets, making cross-border capital flows more resilient. During global economic fluctuations, market participants can use derivatives to quickly adjust portfolios or hedge against risks, preventing large-scale capital outflows or rapid depreciation. This helps reduce the fragility of the international financial system. The third one, enhancing global price discovery. Derivative markets provide forecasts for exchange and interest rates, supporting international financial decisions. Though international derivatives markets such as currency futures and interest rate options, global investors gain a clearer outlook on future market trends. Core price indicators like exchange rates and interest rates reflect global expectation more quickly, enabling governments, central banks, and international organizations to identify potential financial risks and take preventive measures, thus promoting the robustness of the global financial system. The last one is system risk diversification. This international derivatives market offers a variety of tools that enable risk to be spread across different markets and participants. For instance, sovereign debt or interbank debts can be diversified globally through instruments like credit default swaps, CDS, reducing the impact of any single market or institution's distress on the global financial system. Okay, let's all my friends to introduce the next part.
Let's say something about negative impact of derivatives. A typical example is over-the-counter, which is a form of exchange trading in which brokers or dealers trade directly with one another. OTC markets are decentralized markets and opposed to centralized markets trade on platforms or in venues in which members trade among themselves on a bilateral basis, meaning by means of telephone, facsimile, or email. The major characteristic of OTC markets is that they do not use market infrastructure for the trading phase. There is no use of trading platforms or central venue of execution. When the counterparties bilaterally agree on the contracts and their details, such as price, date, and place of settlement, among others. There are some disadvantages of OTC as follows, such as little transparency, no clearing, no price discovery, no regulatory oversight. Instead of being traded on a standard exchange, these OTC derivatives represent a private agreement between two parties, exposing both participants to significant counterparty risk because of the lack of an official clearinghouse. Without this providing organizational clearinghouse, OTC contracts can fail if their party defaults on his or her obligations because the agreements are made privately. Ambiguous underlying assets, sometimes even on other derivatives. Counterparty risk, the lack of a clearinghouse or regulatory oversight, and constant innovation makes the OTC market far riskier than the ET-traded market. Unsurprisingly, it is in the OTC market that the 2008 crisis developed. Next slide. Companies based in emerging markets suffer more from derivatives market volatility than companies from more developed economies. The left table shows that companies from key emerging markets, such as Brazil, China, South Korea, India, and Mexico, posted heavy losses as a result of the financial crisis of 2008. About the right picture, in 2008, Lehman Brothers, the fourth largest investment bank in the United States, declared bankruptcy protection after failing to negotiate a successful acquisition, triggering a global financial tsunami. So, why has it caused such severe economic losses? The result is clear. The improper use of derivatives led to the economic crisis. It can be noticed that the branches of latest firm are several, indicates that the use of derivatives instruments beyond the coverage of risks of exporters companies was generalized. From the Lehman bankruptcy proceedings, we can know Lehman was a counterparty for guarantor over about 930,000 OTC derivatives, to the extent that these countries did not involve CDIs. They certainly involved unregulated interest rate on currency, foreign exchange, and energy swaps. So, conclusion. If the vulnerability persists in the financial system, authorities must monitor the fragility of the bank and may present portfolio for each bank. If the policymakers make these tools available for this financial institution and provide sound regulations, these instruments can lead to a sound financial industry that for other emerging countries as well. This existence and the product diversity of the in derivatives markets is essential. This is the last page. That's all presentation from us. If you guys have any questions, please feel free to discuss them with us. Thank you.